When the dot-com bubble burst, it shattered dreams and wiped out fortunes. Now, as AI dominates headlines with its meteoric rise, the question lurking in every investor's mind is, are we standing on the cusp of innovation that will power a major bull run like in 1995? Or are we dangerously close to the peak of a bubble like in 1999, just before the Nasdaq crashed by more than 75%? Fortunately, top tech analyst Dan Ives of Wedbush Securities points out that we're in a moment reminiscent of 1995 rather than the peak and subsequent crash of 1999. Drawing inspiration from the past, he recalls the frenzy around the nascent internet market in the mid-90s and the sentiments of revolutionary change, just as AI promises today. It's a sentiment that many analysts share, especially given the undeniable similarities between the two eras. In both instances, experts voiced that a groundbreaking technology was on the brink of fundamentally transforming the global economic landscape. Additionally, external economic pressures such as concerns about the rising national debt in the US added to the uncertainty. And while some experts were also forewarning in the 90s of a looming economic collapse triggered by the nation's deficit, such a crisis never materialized. Reflecting on the 1990s, it was undeniably a time of trepidation, yes, but also of immense opportunity. While skeptics today might see the bloated valuations and think we're nearing another bubble burst, Ives argues otherwise. He firmly believes that we're witnessing the early dawn of the fourth industrial revolution, powered by AI. He envisions a long runway of growth for AI, akin to the early stages of the internet revolution, and estimates that AI represents a staggering $800 billion opportunity. Ives emphasizes that this isn't mere speculation. The potential of AI is manifesting into tangible growth right now. It's important to highlight that during the dot-com era, even amid skepticism and fear, the Nasdaq surged by over 400% between 1995 and the dot-com bubble's collapse in 2001. Although it later retraced a significant portion of those gains, it's crucial to remember that the origins of this bubble trace back to 1995, with the burst materializing much later. One company emblematic of today's AI boom is Nvidia. But unlike many companies from the dot-com era that speculated on potential demand, the demand for Nvidia's product that powers this AI mania is tangible and immediate. Nvidia's stock recently touched unprecedented highs, recording a year-to-date surge of approximately 230%. The financial figures are equally astounding, with Nvidia's Q2 revenue surging by a staggering 101% from last year and reaching $13.51 billion. Jensen Huang, Nvidia CEO, highlighted the surging demand for their data center platform for AI, emphasizing that this isn't mere speculation or future projections. The adoption of AI is well underway. Elon Musk's testament that Tesla would take delivery of Nvidia hardware as rapidly as they can produce it further solidifies this demand. With tech giants like Amazon and Alphabet that have also underscored their reliance on Nvidia's prowess during their earnings calls, it's evident that AI isn't a mere speculative bubble. It's forming the foundational pillars for multiple industries that are about to experience a surge in productivity. While parallels with the dot-com era are undeniable, especially in the hype and investor behavior, significant differences exist. In the dot-com era, many ventures were buoyed by speculations and lacked real-world applications. Today, AI-driven companies are providing tangible benefits. They're changing business models, streamlining operations, and unlocking new avenues. Yet, not everyone is sold on the idea. Some believe we are closer to a dot-com-like crash. As with every gold rush, there's bound to be overenthusiasm. They argue the inflating tech valuations are signs of an impending correction. The dot-com era saw companies merely adding an E at the beginning of their company name or .com at the end to boost their valuations. Today, some companies are merely attaching AI to their name to lure investors without any substantial AI application or differentiation. Similar to the internet businesses of the dot-com era, this kind of speculative investment can be volatile and unsustainable in the long run. So, while Dan Ives of Wedbush Securities paints an optimistic picture, suggesting that we're entering a moment reminiscent of 1995 rather than an impending crash, other prominent analysts are sounding the alarm, warning that the current AI stock boom mirrors the dot-com bubble of the late 1990s. Bill Smead, CEO of Smead Capital Management, expresses deep concerns. He He views the AI-driven exuberance around tech stocks surpassing the dot-com bubble's intensity. For Smead, this isn't merely a heightened moment of enthusiasm. He sees it as a passively dangerous bubble. He argues that passive investment giants like BlackRock and Vanguard have artfully obscured this manic phase by recategorizing prominent tech stocks. For instance, they categorize Meta and Alphabet as communication service entities and slot Amazon in the discretionary sector. Yet, if big tech giants like Amazon, Netflix, and Tesla were added to the information technology category, it would balloon to an unmatched 41.5% of the S&P 500's market cap. Such concentration, Smead warns, has historically spelled doom. He recalls past instances where companies like AOL eventually saw their market capitalization collapse by nearly 97%. Echoing Smead's cautionary tone, Michael Burry, renowned for his prediction of the 2008 housing market crash, has raised concerns about overvalued tech stocks and widespread speculation. His bearish put options on major indexes signal a deep apprehension toward a market downturn. And these concerns are not isolated. Market experts, including David Rosenberg and analysts from prominent institutions like Bank of America and UBS, liken the present AI stock surge to the dot-com era's peak. Rosenberg, a seasoned economist, points out that current corporate strategies mirror those from the dot-com bubble days. James Penny from TAM Asset Management feels the market is currently overshooting its potential. At the same time, UBS's Art Cashin predicts a mini version of the dot-com bubble, propelled by the AI narrative. Back in the camp of the optimists, Wharton's Jeremy Siegel challenges the bubble narrative, emphasizing that many companies with high valuations lacked earnings during the dot-com peak. In today's landscape, the AI revolution demonstrates tangible benefits in real time. Similarly, Tradier CEO Dan Raju highlights the distinction between the two eras. The dot-com phase saw inflated company valuations rooted in unproven internet theories, while 2023 witnesses the concrete realization of AI's promises, with company valuations still appearing reasonable. As you can see, the AI-driven stock boom has ignited a heated debate among experts. The spectrum of opinions ranges from warnings of a looming, painful sell-off to convictions about AI's transformative potential that is just beginning to manifest. As with all financial predictions, only time will reveal the trajectory. And what is our stance, you ask? In our analysis, the AI surge isn't just another bubble in the making. Instead, we believe we are standing on the cusp of a transformative era, one driven by genuine innovations and real-world applications. While caution is always advised, we think there's substantial runway left in this AI-powered bull market. But as always, we encourage you to stay informed, discern hype from genuine potential, and always seek guidance from a financial expert before making investment decisions. Now, we'd love to hear from you. Are we living in the echo of the 1995 internet boom, or precariously teetering on the edge of a 1999-esque bubble? How do you feel about the future of AI investments? Dive into the conversation below, share your insights, and let's navigate this tech-infused future together. And if you found this video insightful, give it a big thumbs up and spread the knowledge by sharing it with your friends. For more in-depth analysis, hot takes, and discussions on the pulse of the tech world, remember to ring the bell for notifications. Until next time, stay savvy and invest wisely.